Good morning, everybody. Welcome to the TAMIM Australian Equity webinar. My name is Darren Katz, and I am the founder and head of investments at TAMIM. Today, we have Ron Shamgar, our head of Australian Equities, presenting. Before we move across into the webinar, we've just got two items of housekeeping to cover off. The first being the disclaimer, which I will put on the screen shortly. If you take a look at the wording here, please just note that what we're talking about today is general advice only and is certainly not specifically tailored to your individual positions. So please don't take anything that is said today as individual tailored advice. While I'm leaving this up here for you to read, the other item we wanted to cover off is that we will be holding a Q&A session at the back end of the webinar. So if you look at your Zoom toolbar on the screen, you should be able to see a Q&A button, and you can press on that to register your questions there. So please put in some questions. We love the discussion. So for those of you that are new to TAMIM, a bit of information about the firm. So we are a boutique investment manager. We've been in operation for just over 5 years now, and we manage in excess of $170 million across equities, property, and credit investments. I will leave the Australian equity segment for Ron to talk about through this webinar, just highlighting before we move into that segment across the other areas of investments. So in the global equity segment, we manage a large cap investment, which has returned approximately 21% over the last 12 months, an Asia small companies portfolio, which has returned around about 22% through the same period. And we have just recently launched a global mobility fund, which focuses on what we believe is one of the largest investment trends over the next decade. Alongside that, we also manage a number of single asset properties, as well as a credit portfolio, which invests into private debt and returns around about 7% per annum, paid out in quarterly distributions. There are three key investment drivers that we've been talking about for a number of years, which we believe impact across most investment markets in today's investing environment. Just wanted to cover off on these three items once again before heading into the Australian equity segment of the webinar. First being low or zero interest rates. And for those of you who've been following us and listening to what we've been saying, we believe that these are going to be staying low for a lot longer than everyone else believes. The key fact to remember here is that until we are actually able to reduce the amount of debt in the system, both here and overseas, it's going to be exceptionally difficult for governments and central banks to raise rates. The second point is what we call government intervention. We used to talk about government stimulus, but given the level of stimulus, or what we should call intervention these days, intervention probably works out to be a better term. With the 24-hour news cycle that we're currently in, what we find is that governments can't or won't take the political pressure from their constituents any longer, and therefore will step in time there is economic pressure in the marketplace. So certainly the one thing that we bear in mind when we run our portfolios is that you don't want to be betting against the government, because they can change the rules at any given point in time. And then the final, slightly more positive driver that we see in the marketplace is certainly innovation. And what we believe is that over the next decade plus, this will continue to drive significant growth, as well as keep inflation under control moving forward. So with that, I'm going to stop talking. Certainly the person you've had to listen to today is Ron Shamgar. So thank you very much, Ron. I'm going to hand across to you.
Good morning, everyone. And thanks for joining the TAMIM Australian Equities webinar today. My name is Ron Shamgar, and I'm the head of Aussie Equities for TAMIM, and I'm also the portfolio manager for the TAMIM All Cap Equities Fund and also the Small Cap Income Fund as well. Today we'll focus on the All Cap Fund mostly. So, in terms of our investment philosophy for the All Cap Fund, in essence, we look to identify companies that meet our fundamental-based investment process. Essentially, we're aiming to generate long-term capital growth by targeting companies that are exhibiting strong financial capabilities. And what we look for is companies that are not just growing earnings, but are generating strong cash flows, and even more importantly, we're looking for industry tailwinds. So we're looking for companies that are not necessarily growing in a structurally declining industry, but in an industry that's got a lot of tailwinds, just like Darren mentioned before, innovation and real market disruptors. So these are the kind of businesses that tend to do well. There's a bit of a snapshot of the portfolio performance of the all-cap fund over the last 1 month and over the last few years. As you can see, for the end of February, we did 4.3%. That's net. All these figures are net of fees. 3 months, so basically 11.4%. And in fact, up until the end of March, so calendar year to date, 2021, the all-cap fund is up 11% net of fees. So that's a really good start to this year. And as you can see, it's significantly outperforming the benchmark, which in this case is the ASX 300. On a 2-year basis, the fund is up just under 40% per annum. That's net of all fees. And since inception, which is approximately 4+ years ago, over 20% per annum after all fees. So really strong returns that we're quite proud of. So I guess we'll talk about a little bit, just not dwell too much, but a little bit of a recap on 2020. Obviously, it was a really significant year on all aspects, and then we'll talk about the outlook for 2021, why we're quite bullish. But it's really important to talk about 2020 because it really shows that we can really adjust to all events that are thrown at us. So if we look back at early 2020, we actually started that year really strong. And then, as we all know, COVID emerged in late February, and through March, governments around the world reacted, to be honest, and frankly, caught us off guard. I never believed that the world would just shut down, but we got it wrong at the time, and it did shut down, and markets probably had they did have the quickest 40% sell-off basically in human history. The all-cap fund at the end of March last year was down minus 30%. So obviously we got hit quite hard, just like a lot of other people did. So how do we react? So instead of panicking, instead of going to 100% cash or just sort of doing nothing and just hoping for things to recover, we really took a really proactive approach. And by April, with company updating the market, we started to kind of identify and realize who are going to be what we call the COVID winners of the result of government actions and lockdowns and so on from this pandemic. And we kept really close touch with management teams. I was on the phone, with 5 or 10 different company management teams on a daily basis, and really trying to understand what are the impacts for every business from what was happening, and who was going to be a winner, who was going to be a loser, and so on. And so by doing so, we actually adjusted the portfolio. Some positions we exited because we just didn't have the confidence, that they would benefit from the situation. And then we took a really active approach and invested in what we call the COVID winners. So these are companies that we spoke about last year, e-commerce businesses, payments companies, as people were looking to avoid using cash. Obviously, people were staying in their homes, so they were buying online. And by buying online, there were also a lot of companies, a lot of consumers were using, consumer sort of budgeting or lending tools, such as the buy now, pay later companies. For example, we bought Sezzle at the time at around $2 a share, and that sort of went up to $10. We went into e-commerce companies, online lotteries, for example, payments businesses, and so on. And so we really took quite a lot of investments into what we call the COVID winners, and we outperformed significantly since that end of March. So as you can see, performance as of end of March this year compared to end of March last year when we were down, the fund actually was up 110% net of all fees since the end of March last year. So we completely outperformed the market. And as you can see, if you just step back and We look at, obviously, since I joined in 19, I had a very strong year, 56% after fees, again, outperforming the index materially. Then even in 2020 and after that end of March, huge sell-off, still finished the year really strong, 18% after fees. And again, significantly outperforming the market, even after being down so much in March. So we can really adapt to the situation. And then this year, again, calendar year to date, 11% after fees, again, outperforming the market. So the way we look at it is, whatever gets thrown at us, we're able to adapt and to the situation and the reality that we have today. So let's leave the past and look into the future. Why are we positive in equities this year and, for the next few years, really? So as Darren mentioned, global interest rates are going to stay at near zero levels for the foreseeable future. I mean, we've had the central bank, the RBA, in Australia talking about not raising rates until 2024, for example. They've already finishing their second QE program and going into the next quantitative easing money printing program in Australia. They've already bought approximately $200 billion of government bonds. That's not going to change anytime soon. Globally, rates are at zero. And basically, consumers, investors, no one's getting any yield on their cash. They're getting absolutely nothing in the bank. And so, we believe that that there's a new generation of what I call young investors. People in their 20s and 30s and even 40s. They've worked really hard. They've saved a lot of money. They're actually quite cashed up. The pandemic didn't hit them as hard as everyone thought. Obviously, government assisted them. Most of them have kept their jobs, but they're getting absolutely nothing in the bank, and they want to make money. Now, going into property is a little bit out of reach. You need a large sum of money to get in. And so really for them, these are a new generation of investors that are looking to get a better return in equities. And so they're the ones that are coming into the market as new investors. And we've seen that coming in quite strongly. And a lot of them, whether they're buying the right stocks or not, it doesn't matter. There's a lot of money that's coming into the market. And that's going to continue for the next few years. Now, if we look at the government, so since the crisis have begun, approximately 20 trillion Aussie dollars has been created of new money supply printed around the world in terms of assisting, in terms of liquidity for the financial system, and obviously governments spending money on stimulus, trying to get the economies going, and obviously maintaining people's jobs due to the lockdowns. That is a significant amount of money that's been printed. And if we just compare that back to the GFC in 2008, back then, approximately around $2 trillion of new money was printed at the time to support the crisis back then. So this is a magnitude of 10 times compared to the GFC. And this money has to go somewhere. And it's gone partly to consumers, as I mentioned before, and it's going into asset prices, property, and mostly equities. And this is why we're seeing equities where they are. And, that money is driving equities higher and higher because you're getting nothing in the bank. Now, the good news is that the vaccines are being rolled out around the world, especially in the US. I think approximately 120 million Americans have now been vaccinated, at least with one shot. And we're seeing the COVID number of cases, hospitalizations, and deaths plummeting. And we're seeing the US economy rebound really, really strongly. And we believe they're going to have an extremely strong rebound out of this pandemic. We're already seeing job openings in the US are at record highs. So that's really positive because, as we know, the US economy does well, the rest of the world does well. We're seeing similar vaccine rollout successfully being done in the UK. The Europe is still a bit of a mixed bag, but eventually we're going to get there. So, we believe that as the vaccines roll out and the pandemic sort of eases, we're going to have international borders reopen. And when international travel recommences, the world economy will absolutely boom. And when this happens, businesses are going to do well, consumers are going to get confidence, they will spend even more, they'll go traveling, and economies will grow, and equity markets will follow this. Now, obviously, you have to pick the right businesses in the right industries at the right time. and this is what we believe we are picking. So look, we have to expect some volatility as well, and nothing goes up in a straight line. But same as the last 100 years, after such a tremendous crash, there's always some concerns that we might have another correction. We don't believe that's the case. There will be some small pullbacks along the way, maybe 5, 10, 15% at most, just like we had after the GFC. But overall, we expect the markets to continue their march higher. And if you pick the right businesses, you're going to outperform. Another element of what we're seeing is there is a bit of rotation back to value. Now, we try not to sort of differentiate too much between value, growth, businesses. I mean, at the end of the day, whether a business is so-called a value stock or whether a business is a high growth business, I mean, we're trying to buy a business that's going to grow its earnings, and we're trying to buy it at a discount to what it's worth. And that to us is value. So we're not trying to pay too much attention to the discussion between, what's going to perform better, growth stocks or value stocks. We're just trying to buy businesses at a big discount to what they're worth that are growing. So as we're seeing now, as I mentioned last year, the COVID winners were the ones that were driving a lot of the performance. But as the economies are reopening and lockdowns have eased, we're seeing the so-called old world economy businesses are recovering. A lot of these businesses are going to benefit from the massive stimulus and infrastructure spending that's going to go around the world, especially in the US. We know the Biden infrastructure plan is worth almost $2 trillion. And I think 600 billion of that will be spent on infrastructure, for example. So these are the kind of companies, sort of old world businesses that were sort of boring during last year, but they're going to benefit really well. And we've positioned our portfolios a little bit more into these kind of businesses that we think will benefit from this thematic. And we've actually done extremely well over the last 4 to 5 months from these. And I'll talk about some of them later on. And then there's going to be a search for dividend yield. And as we know, a lot of the growth stocks don't really pay too much of a dividend. But some of the old world economy businesses, they usually pay a really good dividend yield. And we're going to see investors looking for yield. And there are quite a few businesses or stocks out there that are paying 5-7% fully franked dividend yields. And we think that when they can prove to the market that they can grow their earnings as well, then obviously those dividend yields will get compressed as the share price goes higher. So that is going to be the thematic this year and over the next 3 to 5 years. So a little bit about our portfolio and how we construct it, and what's really our investment style. So we probably own anywhere between 30 to 40 stocks or companies in the portfolio at any point in time. And, we're obviously not going to get all of them right, and we usually get a handful wrong a year. But as long as the other ones perform well, then that's really the recipe for success. And I think that mixture between 30 to 40 stocks is sort of a good balance between diversifying in order not to sort of bet the farm on 1 or 2 stocks, reduce volatility, but also not be over diversified and really lose some of that upside from having conviction. So what's our kind of biz? What's the kind of business that we're really looking for? So the main thing that we like is revenue visibility. You want to, there's nothing like waking up in the morning and knowing exactly how much you're going to earn in the next 12 to 3 years from now. And so we're looking for businesses that have recurring or contracted revenue. And there's nothing worse than sort of lumpy contracting businesses, that can only have visibility over the next 3 to 6 months of how much money they're going to earn. So, companies that essentially have long-term contracts, or that the service or product or solution that they provide to their customers is recurring in nature and is something that people use on a regular basis. And we're looking for businesses that, generate high cash conversion and really require very little capital expenditure to drive their business and grow. And these are the kind of businesses that, generate good cash flow and can then use that cash to either reinvest and grow their business, do acquisitions, or return it to us shareholders as dividends, or in some cases buybacks. Ideally, our kind of business has a conservative balance sheet. Now, we're not necessarily afraid of debt. I think some levels of debt are good, and sometimes some companies that have a resilient business model generates good cash, but maybe have a legacy balance sheet issue, a high debt issue, but they can really manage that debt quite well. Sometimes those businesses can present really good opportunities for investors, as other investors sort of shy investing in these kind of companies. But ideally, we want a business with a good, strong balance sheet, and we look at things like, interest cover, debt to equity, debt covenants, and so on. What can really trip this business if things go a bit wrong? And probably the most important aspect of the kind of business that we like, and especially when you focus on smaller companies. So, top 50 ASX companies, I would argue the management is not as important. Those businesses are big, and if you have someone that's not very good at the helm, they probably can't do too much damage. But when you're looking at that small end of the market, maybe ASX 300 companies, or even smaller, where obviously the upside is much greater, management is everything. It sometimes, in my opinion, is better to have a pretty average or mediocre business with an amazing management team than actually a really good quality business, but a very, very low quality or, average management team. Because to me, management is key. Managements are the guys or girls that are running the business. They have the vision, they have the execution. And if they've done it in the past, and they're incentivized, obviously, and they're aligned with us in terms of their shareholding or their performance options and so on, and then we believe that we can back these people, and they can generate good returns for us investors. Now, unlike some investors, we try not to focus too much on the little details and try and take a big picture view, because to me that's really important. You're trying to understand what's driving the revenue and profits of a business. And like I said, is this a disruptor, or are they being disrupted? And you really got to understand the industry and the tailwinds that are happening in it, and really try and see whether this company is innovating or making a service or product more efficient, or they're just competing on price, or are they being disrupted with new technology and they're not really adapting and spending the money on improving, and they will get caught out eventually. So, sometimes you look at businesses and they seem really cheap, but it could be a business that is actual in structural decline and what we call a value trap. And then, big picture is important. We're looking for businesses that have momentum and are going to outperform investors' expectations. And this is really the key. A business that is going to outperform what everyone thinks it's going to do. And to identify that, you really have to be close to the management teams, talk to them regularly and understand what's happening. And then obviously you have to identify what's going to re-rate the share price, what's going to make investors buy. And that's what we call what's our upside. Obviously, when you find that business and it ticks all of those boxes, you then try and forecast what is it going to earn over the next couple of years. And then you obviously use several techniques like this kind of cash flows and comparing it to some of its peers in terms of multiples and so on. You get a valuation, and you're really trying to buy it at a discount. So, if we think a business is worth $1 in 2 years from now, there's no point buying it at 90 cents today. And we're trying to buy a business that's worth $1 in 2 years from now at 50 cents today. And so, apart from doing that, we're trying to understand the catalyst to re-rate the share price. So what is going to drive that, which is really important. And just generally, we like to kind of say, well, we'd rather be approximately right than precisely wrong. So whether a business is worth $1, $1.10, doesn't really matter if we're buying it for 50 cents. So this one is just a quick chart that I think I'll briefly go over. But basically, what we're trying to say here is don't try and time the market. And this is a table that shows the returns of the markets over the last 10 decades. And really, if you look at the price returns for every decade on the left side, and then, if you're the best market timer in the world and you excluded the worst 10 days per decade of investing, then you've done ridiculously well in that second column. But that is literally impossible. The point is that on the third column, if you obviously trying to time the market, but you missed out on the 10 best days per each decade in the stock market, if you look at those returns, you have completely underperformed the market. And this is the key here, is that the benefit of being in the market outweighs the risk of missing out. So, the time in the market is really what's important. And, yes, we've had a big correction a year ago, and sure, we'll have pullbacks along the way. But, I won't forget after the GFC, for literally 5 years, I've had investors coming to me telling me the next GFC is coming. That's just not the way to make money in equities. You got to be investors. You got to pick good businesses. You got to diversify. And as we've shown last year, even after such a big correction, you can adapt and we can generate strong returns. So I guess maybe this is probably I think the most interesting part of the presentation, and really talking about some of the stocks that we like and we own. And, I think at the moment, our largest holding in the fund is a company called EML Payments. This is a true growth business. It's a global payments platform issuing both MasterCard and Visa, digital cards, physical cards, whatever you want to call it. And this is a business that really has an amazing management team that we know really well. It started off nothing really about 9 years ago, and it created a global business that will process $20 billion globally this financial year. Now, EML services a real range of industries and clients, from government to fintechs. Obviously, they do gift cards around the mall, around shopping malls around the world, virtual cards, salary packaging solutions in Australia for the likes of Macmillan Shakespeare and Smart Group, gaming payout cards for the online sports betting businesses, digital banks, buy now, pay later, and so on. As you can see on the bottom right chart, this business over the last 5 halves has grown GDV, revenue, and profit, EBITDA, which is very unlikely for many growth and payments businesses. And this is what we like about this company. Management are not just growing the top line, they're growing the bottom line, and they're growing it profitably. So EML has actually made last week a game-changing acquisition. They bought the open banking business called Centennial in Europe, and its subsidiary NeuroPay. Now, this is really important to explain. They bought the business for about $110 million plus a $60 million earnout. And what we like about this, even though the size of the acquisition is not significant for them at the moment, we think this is a transformative acquisition for EML. And it basically lets them enter the fast-growing open banking sector. Now, open banking is taking over the payments world. It's still not yet here in Australia, but in Europe, it's driven by regulation and it's taking off. And essentially what it allows is consumers to pay merchants or pay other consumers from one bank account to another bank account instantaneously. Now, by doing so, you really do bypass the card scheme operators. So think about Visa and MasterCard. You're bypassing them and you're going directly account to account. Now, the benefit of that is that it reduces the cost for the merchant significantly. It's a lot more simpler for the consumer, and it reduces fraud dramatically. And therefore, things like chargebacks and so on don't really exist as much. Now, the card scheme operators such as Visa and MasterCard are quite worried about this, and they are forecast that the open banking sector will take about 30% of their future revenue. And so this is a big opportunity, and EML is now in that sector and is going to grow fast. Now, the management is forecasting that Centennial will contribute about $23 million of EBITDA in year 3 from owning the business. And so that would be probably around FY24. And so, by adding that to what we believe EML will be earning at that time, we think the valuation of EML is approximately $8 compared to, I think it's $5.80 today. Just as an example, we bought EML at $1.35 initial entry price, maybe 2 and a bit years ago. And this is a business that has 90% of its revenue recurring, it's cashed up, the board owns shares. In terms of capital, that there are more acquisitions to come. They still have 120 mil of cash on the balance sheet. They got a 200 mil debt facility that's unutilized. So we expect more deals to come maybe later this year. We expect some good new contract wins, probably in that fintech space and probably in government disbursements as government look to, stimulate their economies. EML will win those programs in Europe and the US. And they will update their guidance, which was given in February, probably around May or June this year. And we expect them to come in at the top end of their guidance, around 55 mil of EBITDA for this year. So again, great business, growth stock, ticks all the boxes, our largest holding at the moment. The next one is actually a growth stock, but it's trading like a deep value play, which is quite bizarre, but that's just the nature of Resimac. So Resimac is one of the largest non-bank mortgage originators in the country. It's got a loan book of approximately $15 billion. So what Resimac does is it goes out to the institutional market, it raises money, what they call RMBS funding programs, and then they lend that as mortgages to people looking to buy a home through the broking channel in Australia. So they're one of the largest actually in the country. The market cap is $900 million. What we like about it is obviously it's going to benefit from a really buoyant property market, which is it's starting to overheat, but as we said, there's a lot of tailwinds for the property market. So we don't see any sort of issue at the moment. They've had an amazing track record of growing their profit after tax over the last 5 years at 50% per annum. They've given guidance this year that they will do somewhere between $100 to $105 million of NPAT. This is net profit after tax. That is a significant number and almost 100% up on last year. We believe that they will outperform that guidance by about 10%. And we're seeing good, strong momentum accelerating in their business. They have a net cash balance sheet. They actually pay a nice growing dividend yield as well. And it's really cheap at about 880 or 900 mil market cap. You're buying a high growth business that's been growing at 50% per annum, paying dividends, and you're buying it on a P of 8. Its peers are trading on 12 to 13 times. We think it's too cheap. We initially bought Resimac at 55 cents. It's currently trading at about $2.20, and we think it's worth at a minimum $3.50. Now, what are the catalysts? I think the catalysts are, we believe that they will upgrade profit probably around June this year. Management tend to be quite conservative. And obviously, this is not a sexy business like a lot of the technology businesses. And so a lot of investors are not very interested. It's also not the most liquid stock. I mean, the board and management own 60% of the company, but we see that as really positive. They're aligned with us. And so we think that over time, just like we bought at 55 cents and it's now $2.20, over time, the share price will re-rate to at least our valuation of $3.50. And there's a few of its competitors that are coming to market and listing in the next few months. And I think that could be a catalyst as well to get it going. Now, this is another growth stocks that we love. It's called Unity Group. This is an amazing story. 2 years ago, this business was doing 10 mil of revenue and was just doing an IPO, was trading at around $20 million market cap. And then it had a few of the executives that had a really good track record in the telco industry, from M2 Telecommunication, Vocus, and so on. They took over the company, they joined the board, and they completely shifted its strategy to become a core infrastructure fiber provider. So if you think about them, they're basically a mini NBN. If you ever wanted to own the NBN, but you can't, well, if you own Unity Group, you basically own a mini NBN, but a much better business, a high growth business, a super profitable business. Now, they are basically an alternate provider to the NBN, especially in multi-dwelling high-rise buildings and a lot of greenfield development and housing estates. So what they do is they partner up. Sorry, we're back online. So back to Unity Group. So yeah, again, a mini NBN, alternate provider to NBN. They partner up with the property developers, and essentially the property developers pay Unity Group to install fiber in the ground. And then once that's provided, when people buy their homes or they build houses there and they move in, when they connect to an internet service provider, that internet service provider has to buy the internet data connection, the fiber connection from Unity Group. On average, Unity Group gets approximately, say, $50 per connection, and the internet service provider, sells that on to their customers for maybe $75 a month or so on. Now, this is a recurring, contracted, super defensive, sticky revenue business model with extremely strong cash flows. They probably own about Unity does about maybe 20% of all greenfield developments in Australia. The rest is the NBN. But we see management want to get that to over 40% as they offer more service providers on their network. So they recently made an acquisition from Telstra for some of their fiber assets, and Telstra has become an internet service provider as well, which is significant. And then we think Optus will come on board as well, and therefore they'll have exactly the same internet service providers as the NBN, but they'll be able to offer a better service to these developers, and so they'll win bigger market share. Now, if we look at this slide on the top right side, this is probably my favorite slide, and this is probably a slide that I don't think there's any business on the ASX that can talk about this. But essentially, if you look at is what they call a do-nothing scenario. So if Unity Group absolutely did nothing over the next 5 years, and all they did was connect the contracted pipeline of premises, which is 200,000, that will deliver to them $240 million of construction revenue. And by essentially, they currently have approximately just over 100,000 premises connected. So by just connecting the current pipeline of 200,000, they double their active services within 5 years. And essentially, the current exit run rate of that division is $80 million of EBITDA. So by doubling it, we're looking at a business that will, in 5 years from now, by doing absolutely nothing in terms of growth, will generate 160 mil of EBITDA. Plus, we have some of the other sides of the business, which provides services and solutions to small businesses, which probably makes another 40 mil. So this is a business that in 5 years from now is almost certain to do 200 mil of EBITDA, and 70% of that is recurring fiber, what we call core infrastructure. Now, we believe that Unity Group should be valued on a core infrastructure valuation, which is more 18 to 20 times EBITDA, rather than a telco business that trades on anywhere between 8 to 11 times EBITDA. And so we've been saying that for a while. We initially bought Unity Group around that $1.20 mark. It's currently trading at $2.50. We believe it's worth well north of $3. And potentially in 5 years from now, if they deliver that 200 mil of EBITDA, that business could be worth over $5. We're seeing their momentum accelerating. We expect them to give a slight upgrade on their recent February run rate update of 200 mil revenue and 160 mil EBITDA. They are acquisitive. There's not a lot of fiber assets to buy anymore, but we think they're going to continue to acquire some internet service providers in that sort of greenfield sort of development area that they're targeting, and that should drive profits and revenues higher. Now, obviously, they're a beneficiary from COVID as people are working from home and using more internet and data. but we don't see that stopping. It's only going to accelerate. So the next catalysts are a guidance update, which we think they'll upgrade, other acquisitions, and entering the ASX 200 index, which is imminent. So an amazing business that we own and we like. So the next ones is what we call stimulus winners. So these are two businesses that on face value are pretty boring. Again, they're not none of that sort of technology, sexy businesses, but here's the kind of businesses that we like. In fact, Cardno and Integer were the same company up until a year and a half ago. And they Integer demerged from Cardno as a separate business to focus on what it does. And so they demerged in late 2019. And so if we focus on Cardno, it's a $280 million market cap. They're kind of a leading global professional consulting group. They focus on environmental, government, and infrastructure services, Asia Pac, and obviously North America. For obviously they initially they did get hit somewhat in terms of lockdowns last year, but they are going to really benefit as economies reopen, and you know their consultants are able to get out there and do work. They should do approximately $840 million of revenue for financial year 21, and they've guided. In fact, they've upgraded their EBITDA by about 10% to $50 million. So this is a really profitable business. Now, what we saw unique about this is they had a really strong balance sheet. This business generates good cash flows, and we bought them later last year at 31 cents. And at the time, we saw that management announced a 10% buyback of their stock. And they were quite aggressive in buying that stock. And we saw that essentially as a downside protection with us buying the stock. I mean, not just on fundamentals of being cheap, but management were buying back stocks, so they're sort of protecting our downside. In fact, management was so aggressive that they bought 10% of the stock on issue within 3 days. It's almost unheard of on the ASX. And so they obviously see significant value, just like we did at 31 cents. And the good news today, the share price is 70 cents. And our valuation is well north of 75 cents. They actually started paying dividends as well. So they're paying about 3 cent fully franked dividend. So that's almost a 4.5% fully franked dividend yield. And they actually recommenced another 10% buyback. And then again, they've been aggressively buying back stock. And I think that the latest buyback price was 68 cents. So again, it's a unique situation where they're a beneficiary of, you know, the stimulus and reopening. And we've got management that are essentially protecting our downside by buying stock because they see the business is really cheap. Now, on the other side, Integer, which demerged from Cardno, that's another business that we like that's going through exactly the same scenario as Cardno. So they're a leading North American and Australian engineering services provider, and they focus really on asset and infrastructure integrity and testing. So if you're building a bridge or a highway or whatever, you know, there are regulations that require materials to be tested. And so this is a global business, heavily focused on North America, Australia, and New Zealand. And now that they've emerged from Cardno, they can really focus on their own business and start focusing on growing that business and through acquisitions. Now, they've given guidance of approximately $420 million of revenue and 49 million of EBITDA. They're modestly geared, about 1 times EBITDA debt. And they actually started paying a dividend as well. So they're paying about 2 cents dividend, which is approximately 5% unfranked yield, trading on approximately 10 times PE. Again, we bought this at 30 cents. We value this business at 55 cents plus. It's currently trading around 49 cents. And this is, again, a similar situation. They've announced a buyback and they're aggressively buying back stock. They're not as advanced as Cardno in terms of buying back, but they are, you know, they've been paying up to sort of 46, 47 cents a share. And they obviously see value in the business. And again, at the bottom here, both businesses are going to benefit from this Biden stimulus plan. We see the buyback as positive. They are a beneficiary as economies reopens. And so we believe that, in fact, they are both takeover targets. It's interesting that Crescent Private Equity owns 60% of both businesses. And we think that at some point they decide to exit, then we might see a change of control transaction and so on. But in the meantime, they're both growing, paying us good yield, and they're buying back stock. Finally, before we finish off, I'll talk about some microcaps. Companies that are sort of sub 50 mil market cap. In fact, some of the best opportunities on the ASX are microcaps. I mean, if you look at EML Payments, was a sub 50 mil company 9 years ago. Altium, which is an ASX 100 business worth $4 billion, was actually a 50 mil market cap business back in 2010-11 when I was buying shares in it. And so, obviously, most market caps don't become large businesses, but some do. And if you back the right ones, you can make significant returns. So these are two companies that we like in this space, just to highlight a bit of diversity in our portfolio. So the first one is RPM Group. We're really excited about this company. So they're an automotive business, and it sounds pretty boring, but boring can be really, really profitable. They're selling tires, motorsport apparel, and they run mechanical workshops around the country. And they're an acquisitive company. They're a little bit of a roll-up. Think of it like Bapcor. In fact, Bapcor is really the same kind of business, just with large scale. And there's actually a bit of a connection between RPM and Bapcor, and I'll talk about that in a second. And they also focus through some of the acquisitions on the agricultural and rural sector, selling tires and so on to the sector. And that sector is actually doing quite well at the moment. So we see them as playing on the thematic of, domestic travel and people avoiding using public transport. So, as more and more people use their vehicles, there's going to be demand for repairs, tires, wheels, and so on. A very acquisitive company. They're targeting about 150 mil of revenue in the medium term through acquisitions. And this is a business that should do at least 10% EBITDA margins. The current run rate is about $55 million of revenue and $5 million of EBITDA. And their balance sheet is cashed up. They got about $6 million cash from raising money in sort of November, December last year. We expect them to give a really strong trading update at some point. I mean, we've seen one of their peers do the same recently, and they should be starting to do some further acquisitions as they flagged when they raised money. What we like is the management and the board are the largest shareholders in the company, and more importantly, they have a track record. So in fact, they built a similar business to RPM back in 2010 up until 2015 when they sold that business, which was called Opposite Lock, to Bapcor for $35 million. And today, they actually regret doing that because they sold too early and they could have made significantly more money. What we like is they don't want to do the same mistake here. So we see them as very motivated financially, which is always a good recipe for upside. So we bought RPM at 24 cents. It's currently trading at around 42 cents. We think this business is worth $1. And we think that if they execute well and continue to acquire businesses, then, this could be the next kind of Bapcor-like success story. And who knows, maybe Bapcor will come and buy them one day in the future. So acquisitions, a strong quarterly update, and research coverage. No one really covers this company. So there's no brokers that are covering it. It's still small. It's still under the radar. And that's how we like it. And then finally, the other one is a company called 8Common. It's actually a customer of EML Payments. They provide expense management software, and they specialize in that government and not-for-profit sector. So if you can think about it, when the government staff and so on are spending money, traveling, and so on, and same with the not-for-profit sector, you need to manage that expenses, and they have the software to do that. They compete with, their main competitor is SAP, for example, so a big giant compared to a little minnow like 8Common, whereas 8Common has a significant share in Australia. They will benefit from reopening as travel recommences, obviously. Now, they recently launched Card Hero with EML as the technology provider. And what we like about that is Card Hero targets initially that sort of NDIS sector, National Disability Insurance Scheme with the government. It's a $4.8 billion scheme. And those cards essentially enable to prevent fraud by, whether blocking a transaction or approving it instantaneously with the email technology in the background when staff of some of these charities, they get funding from the NDIS, spend money on customers' behalf. So why is Card Hero exciting? Because it increases the total addressable market significantly, and the ARPU is 6 times higher than the traditional expense management software. So they're on the verge of profitability, we think. And, in the next 2 to 3 years, we think they could do 60 mil revenue, 5 mil EBITDA. If they do that, it's worth, anywhere north of 30 cents. And there's one broker with a 50 cents a share price target. So again, contract wins, resumption of travel, that's the catalyst to re-rate this stock. And another little small cap. So I'll finish off on this note, and I'll let Darren quickly talk about a few other things before we go to the Q&A.
Thanks, Ron. That's really appreciated. Just wanted to head on to one last slide relating to the portfolio before we take questions, and just give you an update or some information around the functioning of the fund itself. The one big lesson we took out of March last year was that when the market melted down and everything came off significantly from a share price perspective, it was very difficult in a long-only portfolio to protect value and retain value in that portfolio for our investors and ourselves. We took a decision at that point that we never wanted to experience that kind of a sell-off again. And what we've actually done across all of our Australian equity portfolios is we've actually included insurance in a format across all of our portfolios going forward. So the way we've actually done that is by including long put options in our portfolios. And essentially what that does is when the index, which is what we take the put options over, gets sold off or comes down in pricing or valuation, the put options make money for the portfolio. We tend to do this investing in the put options in slightly longer dated contracts, so anywhere from 6 to 12 months out. And we tend to do this around about 10% out of the money. So we try to do that to control the costs of putting the put options in place. Now, we do realize this doesn't give you a perfect hedge, but what it will do in the case of a significant negative downside movement in the market is create an environment where the put options will earn you money. And it will then allow you at probably the worst point in that cycle to have cash in your portfolio to deploy back into the marketplace should you desire. Now, to give you an indication of what our put options do for the portfolio as of today, we just ran some calculations around it to give you an understanding of how those put options work. In a scenario today of the market falling by 10%, the put options would actually create an environment for our portfolio where we would only be down 4%. If the market were to fall by 20%, our portfolio, assuming that we moved together with the marketplace, would actually be up by 2%. And in a case of a 30% fall in the market today, the portfolio would actually make money and be up by about 18%. So it just goes to show that it's important to look at not only the stock picking and the portfolio construction of your investment, but also is there a smart way to protect yourself against your feelings of concern around could there be another meltdown, could there be another shutdown by governments, and what we've been able to do across the portfolio through these put option positions is provide that level of protection to the portfolio. Just moving to the last slide. to cover off on some of the structures or the structural components of the unit trust. Obviously, the all-cap portfolio is available as an unlisted unit trust. We do also have that available as an individually managed account to investors. However, the minimum investment on that is significantly higher. So the minimum investment across the fund for the all-cap portfolio is $100,000. The management fee comes in at about 1.25% per annum, with an admin and an expense recovery fee of 35 basis points. There is no exit fee on the portfolio. There is a performance fee of 20% in excess of the hurdle, which is the RBA cash rate plus 2.5%, plus obviously the management fee as well. There is a buy-sell spread of 25 basis points either side, and applications and redemptions can be made on a monthly basis. As Ron mentioned earlier, the typical number of holdings can be between 20 to 50 stocks, and we can hold up to 100% of the portfolio in cash. So with that information there, and I know there were a few questions just around the fee structures in the portfolio, so hopefully that has answered that for you. If not, we're happy to take any questions, emails and calls on it. But just to run through some of the questions for Ron that we've had posed to us. Ron, I know probably the answer to this already, but I might just to cover off. We've had someone talking about gold and short-term outlooks for gold producers. What are your thoughts?
Yes, well, actually, we do not invest in resources or mining stocks, so we don't really need to take a view on it. As you can see, you can make great returns without speculating on the price of a commodity and whether you can dig something out of the ground or not. So we don't really have a view on that, but generally, you know, if gold is some sort of a hedge against money printing, well, I guess gold might go a bit higher in the future. But then again, there's another thing called Bitcoin, so that's another conversation altogether. So we just don't bother with it, and we focus on real businesses.
Thanks, Ron. I've got a question here for you around Unity, and it's saying along the lines of, why do the property developers deal with Unity rather than the NBN?
Yeah, well, I mean, property developers are dealing mostly with the NBN at the moment. Something like 80% of all connections at the moment, property developers are the NBN. But we believe, and Unity management believes, that they will take a greater share of 40% plus in the future, because Unity provides a superior service, and they can also offer some commercial incentives as well. You know, being a private business, obviously the NBN, it's a large organization, it's bureaucratic, it's government owned, and as we know, you know, you're never going to get the same service by dealing with a government entity. And I think so. We don't doubt that Unity will be able to take share from the NBN for future development. So that's why.
Thanks. Ron, there's a question here which I might actually just sort of touch on, just around franking credits, etc. In the portfolio. What we're going to do here is we're not necessarily going to be able to get through all of the questions because there are quite a number on them. So any questions such as this franking credit question that we can't touch on, we'll put a Q&A together for everybody, and we'll be sending it out with the recording of the webinar. So if you haven't had your question answered here, you should find it in that Q&A sheet. So next question, wondering if you have any thoughts on the telecom space with both 5GN and WCG.
Yes, Matthew. Look, we actually we do own small positions in both 5GN and WCG. It's probably a bit of a unique situation. The two companies are kind of joined at the hip in a way. With 5GN trying to buy WCG, failing to acquire them. They own a significant share of WCG, which is Web Central, by the way. And in fact, the management of 5GN are the management of Web Central as well. We see Web Central, the business that was really badly run in the past. it's been transformed by these guys. It's starting to generate some really strong cash flows, which will enable them to pay back the loan that 5GN lent them, because they have quite a bit of debt that they had to be refinanced. Web Central will also benefit from a new sort of domain name registered that are going to be released soon. And we just think that the business is going to start generating good cash flow and maybe start paying dividends to shareholders. And also the management of 5GN, which are the management of Web Central, have an option package which incentivizes them greatly by making Web Central hit certain EBITDA milestones. And they've been buying shares on market. And then 5GN itself, it's sort of a data center, telco operator. They've been growing by acquisitions. The share price is down 50%, and we started buying shares recently around that $1.20 mark. They pay a small divvy, and so we think it's probably at a reasonable valuation here. But these are small holdings for us at the moment.
Thanks, Ron. I've just got one here on the cost of the downside protection for the portfolio, so I might just run through that. We would normally expect that to cost us probably around 1.5% to maximum 2% per annum. Obviously, through the course of the 2020 year, volatility, which is one of the key drivers of option pricing, was significantly higher than normal. So a little bit more of a cost to the portfolio for running that protection through the last year. However, what we're seeing now is implied vol on these options is back down to about 12%, which is getting very close to being in line with long-term historical norms. So we think around about 1.5% to 2% per annum, but certainly we think worthwhile in the context of protecting the portfolio from a significant sell-off. Ron, I'm just going to combine a couple of questions here around stocks, and there's just a few thematics that go through, and this might just be the last question. The rest of the questions we'll answer in the Q&A that we send out. So questions around Redbubble, TNT, and SmartPay that you've previously talked about and held in the portfolio. Did you want to give some commentary around those three stocks relatively briefly, I suppose?
Yeah, sure. So just quickly, so Redbubble and Tesserent, these are two companies that we used to own. We did extremely well. We no longer own them. SmartPay we do own, and we're super bullish on, and it's one of our top holdings. I'll start with Redbubble. So that's obviously an e-commerce global business, and that was what I explained before was a COVID winner, and we saw them as benefiting from consumer shifting to buying online, and that structural shift from physical retail stores to people shopping online. So they did really well, and it's actually a really profitable business. We bought that at $1.90. We sold the stock. We initially valued the business at $5 and then $7, and we had an upside scenario which was $10. Now the company did really well. They cashed up. They're profitable. They let us update in February for the sort of second quarter. It was good, but it wasn't as good as we thought. And so although we took profits along the way, we exited our position fully around that sort of $6.50 to $7 mark. And we just felt that Redbubble, although it's a good business, it's not going to earn as much as we thought they will. Some of their gross margins are much lower than we thought, as a combination of obviously selling less face masks, which is a really high margin product. And then also there was a lot of discounting happening, and also shipping costs have been quite expensive with some of the shipping delays around the world. So that impacted them. And the other thing that we are a little bit concerned, and I think the business is fine, and they got a new CEO that came from SICK, which is really impressive. And I think long-term they're fine. Short-term, we're just a little bit concerned, and most of these e-commerce businesses, and this is why we don't really own them at the moment, they're going to all have to cycle these huge growth numbers in their revenues from, obviously that sort of initial post-COVID lockdown period of March, April, and obviously all of last year. So I think that although they're going to do okay, it'd be they're all going to struggle to cycle some of those numbers during this calendar year, and we're going to be monitoring it. And we may just change our mind and we might buy back in, that's okay. Or we might take an opportunity if the share prices sort of sell off And as investors get disappointed with some of those sort of like-for-like sales growth, which will be hard to beat. So that's why we don't own Redbubble. Tesseract was actually our official 10-bagger, which I'm really happy to say. We bought that initially at sort of 4 or 5 cents, and it got to about 40, I think got to 42 or 44 cents. So it was pretty much a 10-bagger for us. Cybersecurity, pure play in Australia. It was a very aggressive roll-up. We kind of always said at the time, it was worth somewhere around that 30 to 40 cents. It got there. At the end of the day, you got to take profits. And then eventually we just noticed that the latest quarterly update was a little bit weak, and we decided to exit the position. And we're sort of monitoring it. It has dropped back a lot. It's around 23 cents at the moment. They had a few accounting issues as well as part of the acquisitions and how they recognize revenue. They did explain it well to the market, and we don't see anything untoward. But I think all these things have kind of like dampened investors' enthusiasm on the stock. And sometimes, I think, knowing when to sell is just as important as knowing when to buy. And, we might decide to come back into Tesseract. And then finally, SmartPay. I mean, obviously, I would love to talk about SmartPay in today's presentation. And in fact, there's a few other businesses that we own that I really love, and they're big positions. But, I'm trying to just give a bit of diversity in terms of the stocks that we own and the industries we're in. But actually, SmartPay is an amazing business. They're a competitor to Tyro and the banks in Australia. Now, what we like about SmartPay is that, as we know, the shift away from cash to electronic payments, has really accelerated due to COVID. And there's about 1 million of these merchant terminals in the Australian market. The banks are obviously not interested in that sector. They're exiting the sector. In fact, they're selling their merchant terminal businesses to other global payments providers. And then you have innovative, agile companies like Tyro, which has about 50,000 terminals, and then SmartPay, which is growing really fast off a low base. They have about 5,000-6,000 terminals. Just to give you an idea, every 5,000 terminals that SmartPay places is about $25 million of annual recurring revenue at really good margins. So we think they're currently on track to add approximately 5,000 new terminals a year. So essentially, if you can think about it, it's going to go from 25 to 50 to $75 million of recurring annual revenue in the next 2 years. And its current market cap is just under 200 mil. It's actually profitable. And then the other thing is that it's got a New Zealand business. They own about 25% of the terminal market in New Zealand. The difference in the model is that they clip a ticket in Australia, so it's much higher margin. In New Zealand, they just rent out the terminals as a rental fee. So doesn't have as much upside. And obviously, New Zealand is a small economy. So that business in New Zealand was actually under a takeover offer for $70 million by Verifone, which is a global giant in the payments world. And they backed away, unfortunately, due to COVID and the lockdowns last year. But, obviously, as we've seen, this sector has actually benefited from COVID. And so we believe now that the Commerce Commission in New Zealand actually approved the transaction. We believe Verifone will come back. We believe that Verifone might have to pay a premium. We also believe that another company called Ingenico might actually do a competing bid for that. And there is also the possibility that instead of just buying the New Zealand market, they might just decide to take over SmartPay and have an entry point into the Australian market where they can just throw marketing dollars at it and take its share. So we like SmartPay, and the future is bright.
Thanks, Ron. With those questions answered, I might just do a quick wrap up of today's webinar. One thing that we'd just like to point out to everyone that's listening in and to all the registrants for today's webinar is that for everyone that has registered for the webinar and who does decide to make an investment at this month end, there actually will be no buy spread applied to the portfolio. So it will be a benefit of about 25 basis points to all investors coming through at the end of this month. Also important to note, there's been a significant amount of interest in this portfolio and therefore increases in investors. We will actually be increasing the minimum investment amount from $100,000 to $250,000 at the half-year mark at the end of the 30th of June. So just please bear that in mind if you're intending to come into the portfolio before then. And just finally, to wrap up, we certainly are very excited around the Australian equity space, and sure, we do understand that nothing from an investment perspective is without risk. Certainly, we take on risk when we're investing. We do, however, believe that the ongoing low or zero interest rate environment, coupled with government intervention, as we've talked about, will continue to significantly drive risk assets. We do understand the risks associated with that, and therefore we do continue to run the portfolio with its downside protection program. And certainly we believe that the all cap and Ron's small cap income portfolio are worth considering for your overall investment portfolio. So thank you very much for your time today, and we look forward to talking again in the future.